Is the US headed for a recession, or are we already in one? Today, we're going to talk about it. Hey guys, I'm Robert Doyle. If you want to learn more about crypto, the economy, and everything else in general, this is the right channel for you. Let's go ahead and get into this because I think the USA is already heading into recession, and it's going to affect not just the US, but the entire world. Because if US citizens don't have the money to spend on all of these extra goods, does that help or hurt the total supply chain? I think it hurts it in a massive way. Let's go ahead and talk to Peter St. Anoje. He keeps it real. I like how he keeps it to the point. He says, when's the next crash? Since the Federal Reserve was founded in 1913, it's caused 20 recessions, about one every 5.5 years. Every time it's the same playbook. Cheap money leads to inflation, which sets off a panic and hikes in the crash. Let me go ahead and play this and we'll talk about it. But the yield curve has been inverted since July of 2022, and usually it's about 15 months, and I'm going to show you that research too, that we enter into a recession. I do think one is coming, and there's nothing that the Fed can do about it besides print more money, and we're not even at a place where we can do that right now. We're still at about a 4% core CPI inflation, and they need to get it down to 2%. They said it's going to take more time to get the inflation when it got from 9% down to 4%, from getting it to 4% down to 2%. So that it's already been what, a year and a half almost, and we've already been through a lot, and it just feels like it's going to get worse.
The most important question right now for the economy, aside from Jerome Powell's metaphors about navigating the dark, is when the recession hits. All major schools of economics predict it is coming, since all major schools know interest rates cause recessions. But it is worth breaking down why. So I'm an Austrian economist, which essentially means a non-government economist. The Austrian school got its name because the Prussian economists were all government funded and the poor Austrians were not. Has nothing to do with Austria. It simply means economists who are not paid shills for the regime. Instead, we actually use economic theory. And 500 years of economic theory says recessions don't happen on their own. They are not a natural part of the business cycle of inflation and recession. Rather, governments cause them. Sometimes by war, but in modern times, almost always by central banks. Specifically, central banks push interest rates too low, which makes money cheap. It's a gift to borrowers, which is rich people and the federal government above all. But that cheap money isn't just a handout. It actually sparks an economic boom as free credit flows to everybody, including to crappy businesses that never should have gotten loans in the first place.
Yes, sir.
The 25th app selling artisanal DIY bentos, perhaps, or NFTs of Bored Apes, or WeWork, the picture. These crappy businesses called Melon.
He went after Bored Ape. Oh shit, I forgot about that was in this clip. That was pretty funny.
Investments can grow like a weed even if they're losing billions of dollars because they just borrow more. Sadly, the boom is a tissue fire. It burns bright, but it burns short. Because all that activity bids up prices, you get inflation. At which point the central bank panics, slams on the brakes, and hikes interest rates, since inflation triggers voters who could push Congress to end the Fed. Hiking rates chokes off new loans, it crushes household spending, so now there's less money chasing goods and inflation comes down. It takes a while since companies and households are still running through the old cheap loans, empirically about 12 to 18 months. So the cheap money made the boom, and then slamming on the brakes made the bust after 12 to 18 months running on fumes. At which point the recession hits, the Fed yanks rates back down to zero, so money is cheap again, and the cycle gets to start over. Government, of course, thrives at every stage of this horror show, which is why it continues. When the money's cheap, government steers investment into politically favored industries like solar or wind, or even into government-funded nonprofits. When the crash hits, they bail out their donors, and they pour fresh trillions into welfare schemes that buy future votes. The end result is a ratchet. Boom or bust, the government grows, at the cost of destroying trillions in wealth and millions of lives over and over. So what's next? Brought to you by Unchained. What's next is we're smack in that running on fume stage, that 12 to 18 month purgatory between panic hikes and economic devastation. Unless the lockdowns themselves cleared out so much dead wood, malinvestment, that we got a clean slate, we are now living on borrowed time, with 12 to 18 months until a recession that, if we're lucky, will only be as bad as 2008. To read the rest of the...
All right. So you also have, right, Kobayashi Letters putting this out. This is an interesting point. I thought it was really cool about the stock market. The S&P 493 which is the S&P including 7 technology stocks, is just up 4% for the entire year. Meanwhile, the S&P 7, also known as the 7 largest S&P companies, is up 52%. Combined, the S&P 500 is up a whole 13% this year. In other words, if you buy the S&P 500 today, you're basically buying a handful of companies that are driving the entire market. Just go out and get the companies. The 7 largest stocks in the S&P now account for a massive of 34% of the entire index value. Without these 7 stocks, the S&P is basically flat for this year. What happens when all the AI hype fades? And also, guys, if you don't know what about the yield curve being inverted, let me go ahead and play this great video for you. It's about a minute and 30 seconds. It's going to explain this to you. If you're not used to watching what has happening in the economy and this yield curve inverting, it's predicted recession after recession. Let me play this for you. Awesome. You gotta love that. You gotta love when stuff just works just like that. Now, if it doesn't work this time, all right, here we go.
An inverted yield curve occurs during the rare times when short-term interest rates are higher than long-term interest rates. The yield curve is a graph that shows the different interest rates paid by bonds with the same level of risk, but different lengths towards maturity. An inverted yield curve slopes downward because short-term interest rates are higher than long-term interest rates. For example, a 3-month Treasury bill may be paying 3%. Meanwhile, a 2-year note is paying 2%, and a 30-year bond may be down around 0.25%. Normally, lenders receive a better yield when they loan money for longer periods of time. When short-term interest rates are higher, it typically results from increased demand for short-term credit. That leads to more demand for short-term debt instruments, like Treasury bills. Inverted yield curves have preceded many United States recessions, and they're used to forecast turning points in the business cycle. For example, in 1980, short-term interest rates climbed to 20%, while long-term rates remain lower. The U.S. equity market collapsed. An inverted yield curve predicts lower interest rates in the future as longer-term bonds see their demand increase, which sends their yields downwards. Yield curves can be normal, flat, or inverted. A normal curve slopes upward, meaning long-term rates are higher than short-term rates. Flat curves reveal interest rates that are about the same.
All right, guys, and then check this out. The bottom line, the yield curve has been inverted since July of 2022, but history has shown any economic fallout following a yield curve inversion doesn't happen immediately. And I said, going back to 1978, it takes about 15 months on average for economy to enter into recession. Okay, July 2023, that's 12 months, August, September, October. Guys, we are at the 15 months. If you look at GDP plus, you can see that we've gone back-to-back quarters negative growth. Are we in a recession? I think we are. Are we heading into a recession that is going to be publicly known? I think we are. I don't think it's going to be a soft landing, guys. I would love to be wrong about this, but I like to look at the facts. And if you look at history, often history can tell us what's going to happen in the future because history always repeats. Thank you guys for watching. Appreciate you. Share with somebody you know. I'll see you again. Thank you so much.